Hi, this is Sharon Smoot with Coldwell Banker, and today I will be presenting the First-Time Homebuyers Boot Camp. And the purpose of this presentation is to answer some of the most common questions that first-time homebuyers have about the home buying process. I am really excited about this boot camp, and I hope that you will get a lot out of it. That's really my goal. I want to help make the process as stress-free as possible and really give you an idea of what to expect as you go through the home buying process. So just to tell you a little bit about myself, I have been a realtor since 2006, and I've been with Coldwell Banker the entire time that I've been selling real estate. And prior to that, I worked as an attorney for about 14 years, 10 of those as a solo practitioner. And my primary areas of practice were real estate closings, real estate litigation, family law, and bankruptcy. So I feel like I have a very unique perspective, a perspective that most real estate agents just don't have, because I understand both the legal side of a real estate transaction as well as the sales side. And I also understand how special circumstances such as a bankruptcy or a divorce or the death of a co-owner or co-borrower can impact the sale of a piece of real estate. So anyway, I want to go ahead and get started. So I'm going to go into screen share mode. And if you'll bear with me for just a minute, we'll be ready to go with the First-Time Homebuyers Boot Camp. All right, this is the First-Time Homebuyers Boot Camp, and I just want to take care of a couple of housekeeping matters first. The first thing I want to tell you is that there is a First-Time Homebuyers Boot Camp companion guide that is available for purchase through my Facebook page. There is a link below this video if you're watching on YouTube, and it will be in the showcase or below the video if you're watching on Google+. And the guide is $9.99. Once you access my Facebook page and click that you want to purchase the guide, you'll be directed to pay through PayPal, real quick and easy. There is also a link for down payment assistance, and when you click on that link, again, you'll be directed to my Facebook page. And once you click that you want to find out if you qualify for down payment assistance, you'll be directed to a page, and you'll need to fill out some information about who you are and the part of town that you want to purchase a home in, and then you'll get a list of what down payment assistance programs you might qualify for. And that information is through a website called Down Payment Resource, I think it is. And I just have that hooked up through my Facebook page. So this presentation is sponsored by me, Sharon Smoot, and I am a realtor with Coldwell Banker. However, neither Coldwell Banker nor any of its affiliated companies endorse this presentation. It's not being off Coldwell Banker, and Coldwell Banker and its affiliates don't warrant the accuracy of the information contained in the presentation. And any products or services offered for sale in conjunction with this presentation shall not be considered an offer to sell such goods or services in any state but Georgia. And if you are in another state, although some of the information in this presentation might be pertinent, it's really best that you seek the advice of a real estate attorney or realtor in your area. And that's important that you're getting the information about how things are done in your state. The information contained in this presentation is deemed accurate, but it is not warranted, and it is subject to change or be withdrawn without notice. So, are you ready to purchase a home? If you answer yes to that question, then I want to help you avoid making one of the biggest mistakes that first-time home buyers make, and that is failing to prepare to purchase a home. So in this presentation, you'll get an overview of the steps you need to take to purchase a home, along with some tips and suggestions to make the process as stress-free as possible. So one of the first things that you're going to need to do is find out what's on your credit report. You'll need a credit score of at least 640 to qualify for a mortgage. There are some programs out there that require a credit score as low as 580. I don't know a whole lot about those programs. I do know that I got a call from a loan officer a month or two ago about her program. So if you have a credit score of 580, it is not hopeless. You may still be able to qualify for a mortgage. You just need to be able to find that program that will work for you. So you're entitled to get a copy of your credit report from each of the credit bureaus once a year free of charge. So in anticipation of applying for a mortgage, I suggest that you get a copy of your credit report from all the bureaus. And once you have those credit reports, you want to make sure that you don't have any collections or judgments on them. If you do, then rather than just jumping to pay off the judgment or the collection, what you should do is make contact with the collection agency or the judgment creditor. Now, I have a loan officer that I've been doing business with for a number of years now, and one of the things that he shared with me is that whenever he has a client who is a few points away from having a high enough credit score to qualify and they have a collection or a judgment, he advises them to make contact with the collection agency or the judgment creditor and find out if they were to pay off or settle the debt, would the collection agency or the judgment creditor be willing to remove the derogatory entries from their credit report? If the collection agency or the judgment creditor agrees to remove those derogatory entries in exchange for a full payment or a settlement of the debt, the next step would be to get a letter from them that says that. The letter needs to specifically state that they're going to remove the derogatory entries from your credit report once they receive the agreed upon dollar amount to pay off or settle the debt. Before you send the money, you want to have that letter in hand. In other words, don't send them any money until they've provided you with a letter. So once you have the letter, go ahead and send them the agreed upon sum and hold on to that letter. Your loan officer might want to see it, and in the event that the collection agency or the judgment creditor doesn't live up to their end of the bargain, you have that letter to present to them showing that you had an agreement and that you lived up to your end of the deal and that you expect them to now do the same. If you have had a bankruptcy in the past, you can still qualify for a mortgage. There are a lot of people out there who have filed bankruptcy and they think that means they'll never be able to buy a house. It's just not true. You'll need to wait at least 3 years from the date of discharge or the date the bankruptcy was dismissed. And of course, you'll have to have the correct credit score and, a pretty decent looking credit report. So if you've had a bankruptcy and the bankruptcy has been discharged, make sure that your credit report says that it was discharged. Make sure that it has the correct discharge date. And the discharge date is the date that appears on the order that you got from the bankruptcy court that says order of discharge. If for some reason your credit report doesn't show that your bankruptcy case has been discharged, it shows that it's still open or that it was dismissed rather than discharged, you need to contact the credit bureaus and make sure they correct that, and you would need to provide them with a copy of the order of discharge. If you don't have that, you can go down to the bankruptcy court and get a copy of it. If you've had a foreclosure or a short sale, you can still qualify for a mortgage. You're usually going to have to wait somewhere between 2 and 5 years, depending on whether it was a foreclosure or a short sale. And in some instances, if it's been more than 2 years since you've owned the property, you may be treated as a first-time home buyer. And that's why I'm mentioning foreclosure and short sale in this presentation. If there are any mistakes on your credit report, you really need to get on top of getting those mistakes corrected sooner rather than later. You don't want your deal to fall through because there is a mistake on your credit report and the loan can't be approved until the mistake is rectified. So if you notice a mistake, go ahead and contact the credit bureau or bureaus if it appears on more than one of the reports, and let them know what the mistake is, and they'll give you the steps that you need to follow in order to get them to investigate the mistake. Once they've completed their investigation, If they conclude that it is indeed a mistake, it will be removed from your credit report. If they say that it was not a mistake, you can still dispute it. You would need to file the dispute form with them. I'll keep that on file, and when someone pulls your credit report, they will see that you are disputing the accuracy of that particular entry on your credit report. And the investigation can take 30 to 45 days or so. So that's why I tell you to be sure that when you see a mistake, that you address it immediately rather than waiting until after you've already applied for a mortgage. So the next question is, how are you going to pay for a home? You can either pay cash or you can obtain a mortgage. And if you choose to obtain a mortgage, you need to understand what a mortgage is. And so in this next slide, there's a short video that will explain what a mortgage is.
Hi, I'm Jessica Edwards with Coldwell Banker Real Estate. What is a mortgage? A mortgage is a loan for the amount of money that you will borrow to purchase a property. You will work with your lender to establish terms such as how much money will be taken out for the home, the interest rate, and the length of time. But keep in mind, your lender and your real estate professional will be there to help you throughout the entire process.
So the next question that many first-time home buyers have is about the interest rate. What is the interest rate? How will they know what their interest rate is going to be? Well, what I can tell you is that your interests vary from day to day based on market conditions. And the interest rate is used to determine your monthly payment in conjunction with a number of other factors, including your income, the amount of debt you have, your credit score, and the loan amount. High-risk borrowers will pay a higher interest rate, and you can lock in your interest rate for a period of time while your loan is being processed and underwritten. So what does it mean to lock in your mortgage? It means that you are essentially paying to guarantee that your interest rate will be what it is today when you close 30 or 45 days from now. So let's just say, for instance, that you were to lock in your interest rate today, and the prevailing rate on a 30-year FHA loan today is 3.25%. Well, when you close on August 31st, the prevailing interest rate on a 30-year FHA loan might be 5%. So because you've locked in today, July 12th, then you're going to save 0.25% on your interest rate. That's essentially how it works. So when you're talking to your loan officer about loan terms, be sure to ask him what the pros and cons of locking in your interest rate are. And he can tell you whether you should lock in today or wait a few days to lock in or what have you. Another thing to discuss with your loan officer is whether you should get a loan that has a fixed interest rate or an adjustable interest rate. If you get a loan that has a fixed interest rate, you are going to pay that interest rate for the entire term of the loan until the loan is paid off, whether you pay it off the good old-fashioned way by making your payments, every month until the loan is paid in full, or whether you refinance it and it gets paid off then. On the other hand, if you get a loan that has an adjustable interest rate, that means that at some point your interest rate is going to change. And from the first time that it changes, it will change periodically until it caps out. So usually with an adjustable rate mortgage, the initial term, during an initial term, usually a year, 2 years, or 5 years, the adjustable rate is fixed, or the interest rate is fixed. Once that fixed period expires, then your interest rate can go up periodically, usually every 6 months or once a year, until it caps out. And the note that you sign at closing will tell you that your initial interest rate is X, and that during the entire life of your loan, your interest rate will never be less than X or more than Y. And most people, when they're nearing the end of that initial fixed period, they'll go ahead and refinance into a fixed rate mortgage. But again, that's something that you should discuss with your loan officer. Ask him what the pros of getting an adjustable rate mortgage are versus the cons, and the same with a fixed rate mortgage. And he'll be more than happy to explain that to you. So the next thing I want to talk to you about is what you need to have prepared, the documents you need to have prepared in order to apply for a mortgage. And basically what you're trying to do is prove that you have the income to pay a mortgage and payment. So you need to get together your 2 most recent pay stubs, your 2 most recent bank statements, and your 2 most recent income tax returns. If you're self-employed or own a business, you may also need to provide a profit and loss statement for your business, as well as the income tax returns and bank statements for your business. If your loan officer needs any additional information from you, he or she will ask you for that documentation. But it's a good idea just to have these items available on the front end. If you're going to be getting a gift for your down payment, you'll need a gift letter. That gift letter needs to be dated. It needs to state how much is being given to you, and that is indeed a gift and not a loan, and it needs to be signed by the person who is giving you the money. If you're interested in getting down payment assistance, be sure to let your loan officer know that. And a proactive loan officer is going to tell you up front whether there might be a down payment assistance program that will work for you. But in either case, you'll be directed toward the down payment assistance program that will work best for you. Now, one of your goals in providing all this documentation to your loan officer is to get a pre-approval letter. And a pre-approval letter essentially states that you have been pre-approved for a loan to purchase a home in the amount of X. In other words, and I've seen it written up a couple different ways. Sometimes the pre-approval letter will say that you have been pre-approved to purchase a home in the amount of X, or you have been pre-approved for a loan in the amount of X. But either way, it's telling a seller that it has been determined based on your financial information, your credit score, that you have the capability to get a mortgage. You need to have a pre-approval letter, I believe, before you ever start your home search. One reason for that is that you know exactly how much you can afford to buy. You'd hate to go out and start looking at homes and fall in love with a house that's worth $250,000 only to find out that you only qualify to purchase a home worth $200,000. Another reason that you need a pre-approval letter is that if you're purchasing a foreclosure or a short sale, you must attach that pre-approval letter to your offer. If it's not attached, your offer won't be considered. A third reason that you want to attach a pre-approval letter or have a pre-approval letter is so that you can attach it to any offer. Doesn't matter whether the property is investor owned, a resale, estate owned, whatever. When you attach that pre-approval letter, you are signaling to the seller that you actually have the capability to consummate the deal. You're not asking them to take their property off in the hopes that you'll qualify. Assuming that nothing happens, you know, your credit score doesn't plummet, assuming that the property appraises for the agreed upon sales price, you will be getting the loan. Now, some people don't understand that there's a difference between a pre-approval letter and a pre-qualification letter. I'm going to tell you the difference. Like I said, with the pre-approval letter, your loan officer has examined your finances, looked at your credit report, confirmed your credit score, and determined that you qualify to purchase a house, that you qualify for a mortgage in a certain amount. With the pre-qualification letter, your loan officer might look at your credit score, but he hasn't really looked at your credit report to see what's on it. And he'll interview you about your finances. He'll ask you where you work, how long you've been there, how much you make, how much you earned over the past couple years, how much money you have in the bank. But he hasn't looked at any documentation to confirm that what you're telling him is actually correct. So that pre-qualification letter essentially is stating that Upon confirmation of all of your financial information, you may qualify for a loan in the amount of X. So you can see from how I've explained the difference between the two that a pre-approval letter is much stronger than a pre-qualification letter. And I always encourage my clients to get a pre-approval letter rather than a pre-qualification letter. So the next thing I want to talk to you about is selecting a mortgage company. You have either a direct lender or a mortgage broker. A direct lender is an entity or financial institution that is in the business of lending money. It is in the business of making mortgages. A mortgage broker, on the other hand, is someone who is in the business of brokering mortgages, much like an insurance broker is in the business of brokering insurance. So when you're working with a mortgage broker, he has access, he has relationships with a number of lenders, and he is able to look at the various loan products that they offer for people who are similarly situated to you and determine which loan product of all the ones being offered by the various mortgage companies that or lenders that he has relationships with. A direct lender has the loan products that they offer. You know, if you're going to, for instance, Bank of America or Wells Fargo or SunTrust, they might have a half a dozen mortgage programs that they offer to their clients, and you're stuck with whichever ones they offer. Whereas with a mortgage broker, there's just a lot more variety and a lot more possibilities to find something that is ideal for you. So you can go directly to your bank or credit union to obtain a mortgage, or you can get a referral from a friend or family member or your realtor. Most realtors are going to give you the names of 2 or 3, maybe 4 different loan officers so that you can choose which one you prefer to work with. You can interview them all, and after speaking with them, decide which one you feel most comfortable with. So the next thing is interviewing the loan officer or mortgage broker. You want to ask them about their experience. How long have they been doing mortgages? Experience. You have some loan officers and mortgage brokers who used to be real estate agents, or maybe they used to be in banking. You know, they might have been a branch manager or whatever. Find out if they have any testimonials from their clients, and find out what they specialize in. I think that for first-time home buyers, it's really, really a good idea to work with a loan officer who specializes in first-time home buyers. When you're working with someone who's very knowledgeable about first-time home buyers, they have their finger on the pulse of what's going on in that segment of the mortgage business. They are very their clients about the home buying process, about the mortgage process. And I just think, like, when I'm working with a first-time home buyer and they ask me for a referral to a loan officer, among the names that I give them is at least one person who specializes in first-time home buyers. And I'll tell them which of the referrals that person is, and 9 times out of 10, that's who they end up going with. If you've had past credit issues, find out if they have any programs for someone with past credit issues. Find out what loan programs they typically offer or are comfortable working. Loan officers who, because they specialize in first-time home buyers, are very well versed in FHA and maybe not as well versed in VA or conventional. So, you know, all of those are important questions to ask. And, you know, feel free to find out anything that you feel is important to your making that decision on which loan officer to work with. Maybe have they ever been subject to discipline? I think that's a good question. Okay, so the next step is 2, and I don't remember what the next slide says, so let me wait for it to advance. Looks like my computer has frozen up. Bear with me for a second. Let's see if it'll go ahead and advance. While I'm waiting to see if the slide is going to advance, I will say this. I am very hesitant to work with a buyer who is unwilling to get the pre-approval letter. You know, I have some buyers, I don't know if they're just excited about the prospect of purchasing a home, you know, or they're hesitant to have someone pull their credit because they're afraid their credit score is going to go down. But if a buyer is unwilling to get pre-approved, you know, it kind of signals to me that they might not be the most serious buyer. Just, you know, gives me pause. So, you know, that might be another reason to go ahead and have your pre-approval letter even before you start calling realtors. I am thrilled to death when I speak with someone and they tell me that they already have their pre-approval letter. So, you know, that's just something else to keep in mind. I thought I'd get up on my soapbox for a minute while I'm waiting for this computer to decide that it wants to advance. Oh, it's just beyond me why this keeps happening. I have started this presentation several times today, and it seems that when I get to about this point in it, the presentation freezes up. So I do apologize for this. Another few seconds and see if it will go ahead and unfreeze so that I can advance to the next slide. I can't even tell if it's still recording. I have no idea what the deal is. Okay, so we're back. I lost you for a minute there, but I am hopefully going to pick up right where I left off. So just bear with me for a minute. I'm going to go back into screen share mode. Okay, I'm getting an error message. The screen share failed to start. Let me try again. Okay, so we're good to go. So if you're going to make an all-cash offer, you really need to get your ducks in a row sooner rather than later. If you need to transfer money from another account, maybe an offshore account, into your Bank of America or your SunTrust account, do that early on at the beginning of your home search. Don't wait until you're ready to make an offer. And the reason that I encourage you to do it early is because you must attach proof of funds to your offer. Whenever there's a cash deal, you need to attach proof of funds. And that proof of funds can be in the form of your most recent bank statement that shows what your balance is, or it can be a letter on your bank's letterhead dated and signed by a bank employee indicating what your balance is. If you're going to get a hard money loan or borrow the money from a private lender, you need to have your proof of funds letters at the time that you submit your offer. So it's really best to have done whatever you need to do to determine that you can get the money from the hard money lender or the private lender before you start your home search. Now, if you're a first-time home buyer and you're watching this video, I just want to take a moment to explain to you what a hard money loan is and what a private lender is. A hard money lender is someone who lends money at a higher interest rate and for a short period of time. That short period of time could be a day, it could 3 or 4 months. And usually investors get hard money loans. And if an investor gets a hard money loan that is only good for a day, that's because they're going to flip the property. If an investor gets a hard money loan that has a 3 or 4 month term, maybe 6 months, it's so that they have time to rehab the property and sell it. So if you're a first-time home buyer, but you're also an investor, a new investor, that's information to understand. Private lenders are individuals who happen to have a whole lot of money, and they may want to get a higher return on their money than they would if they left it in a CD or a 401k or an IRA. So essentially what they do is take their own personal funds and lend them to someone in order to purchase a home. And the interest rate, of course, is going to be a little bit higher because most people who are into private lenders can't qualify with a traditional lender. And so that's just hard money and private lending in a nutshell. There's a whole lot more to it. You can Google it and you'll see there's a lot of information out there. So choosing the right real estate professional. A lot of people get online. I just spoke with a lady yesterday. She got online, went through various realtor profiles, and she happened upon mine. She liked my picture. She liked what I had to say in my profile, so she called me. And there's nothing wrong with doing that. But I do encourage you to interview a couple different agents before you make a selection. And in the interview process, one of the questions that you should ask them is whether they are a real estate agent or a realtor. And although I am using those terms interchangeably in this presentation, and a lot of people use the terms interchangeably, there is a difference. A real estate agent is someone who is licensed to sell real estate in a particular state, in this case, Georgia. A realtor, on the other hand, is not only licensed to sell real estate in Georgia, but is also a member of a local board as well as the National Association of Realtors. And as a member of the National Association of Realtors, every realtor is required to adhere to a code of ethics. And that code of ethics requires that we always put our clients' needs and best interests ahead of everything else. If we're in a dual agency situation where we're representing both the seller and the buyer, we've got to try to put both their interests ahead of everything else. That's virtually impossible because the buyer's interests and the seller's interests are diametrically opposed. That's why I don't do agency, but that's a story for another day. But most realtors take that code of ethics very, very seriously. And in my experience, there are a lot of good real estate agents out there, don't get me wrong. But in my experience, I seem to have had a better experience, and the deals involving realtors seem to go more smoothly than some of the deals I've done where not always true, but sometimes true. Another thing you want to discuss is experience. Experience can be important. One of my mom's favorite sayings is that you can have 1 year of experience 20 times, and you can have 20 years of experience one time. That 20 years of experience one time is a lot better than dealing with someone who's been in any business for 8, 10, 15 years, and it's as though they're brand new. Having said that, if you are interviewing a newer agent, don't just automatically assume that they can't do a great job for you. There are many great new agents out there. They're hungry, they're eager, and they're striving to create relationships, because the lifeblood of any real estate agent's business is referrals. And if you do a shabby job, you're not going to get referrals. So when you're interviewing agents and you come across someone who is newer to the business, find out what type of support they have behind them. Is their broker supportive? Do they have a mentor in their office, or maybe even in another office, working for another brokerage, maybe someone that they've been friends with for a long time who is mentoring them? And if they do, I think it would be okay to go ahead and hire them, as long as they have that support, someone who can answer questions for them and assist them if any issues arise that need resolution. The next thing that you want to find out is whether they have any testimonials they can share with you. Those can be written testimonials or they can be video testimonials. I happen to be a huge fan of video testimonials because I think that when a prospective client sees what a past satisfied client has to say about his or her experience working with me and Coldwell Banker, it sends a very strong message, and it just is a lot more impactful than a written testimonial. But either way, get a few testimonials. Another thing that you should ask is for the agents that you are interviewing to explain the difference between being a client and a customer. If you're interviewing an agent who can't explain that to you, don't hire them, because Lord only knows what else they don't know. I'm going to explain it to you right now, and this is particular to Georgia law. It might be the law in other states, I don't know. But what I'm talking about right this minute is strictly under Georgia law. And what this particular law says is that a buyer must sign either a buyer brokerage agreement or a customer acknowledgement. And depending on which of those documents you sign, that will dictate the level of service that you receive from your real estate professional. If you sign a customer acknowledgement, that makes you a customer. And real estate agents and realtors in Georgia are limited to providing only ministerial duties to their customers. That means that we can help you identify properties that you want to view and help you gain access to those properties. And that's really about it. We can't advise you how to negotiate on your behalf. We can't even draft the offer for you. On the other hand, if you choose to be a client by signing that buyer brokerage agreement, you're going to get a full service experience identify properties that you want to see and help you gain access to those properties. We can advise you on how much to offer, and we can provide you with comps so that you know what home sales are in the neighborhood. We can draft the offer for you, and we can present it to the seller or the seller's agent. And if negotiations become warranted, we can negotiate on your behalf. So you can see that there's a huge difference between the service, the level of service that you're going to get when you're a client versus when you're a customer. So another thing you should discuss with your agent is the effective service area. And the effective service area is the area immediately around the agent's office. That can be a number of cities or zip codes immediately around the agent's office. Some agents not only work their effective service area, they might work the entire county, or they might work a number of metro Atlanta counties. Have an option to deal with or hire whichever kind of agent you feel will give you the best service. And I just want to give you an example. Let's say that you're interested in a house in Locust Grove, and you're talking to me. I really don't know anything about Locust Grove. So if you want an agent who can tell you where the best restaurants are, where's the best place to have your dog groomed, what the parks are like, what the amenities are like throughout the city, you don't want to hire me. I think you would be best served hiring an agent whose effective service area includes Locust Grove. So the next thing that you want to talk about is scheduling. And scheduling can get kind of tricky. It might not seem like it, but think about it this way. If you have a job that you work Monday through Friday from 9 until 6:30, think about it. Your agent probably works similar hours, and you're unavailable to look at homes until 7 o'clock at night. If you hire an agent who has family obligations, maybe they have small children, maybe they're caring for an elderly parent, maybe they're taking classes at night, then looking at homes at 7 o'clock in the evening is not going to be feasible for them. So wouldn't be a good fit. On the other hand, who works on the weekend, an agent who has family obligations during the evening might be a perfect fit for you because they're available during regular business hours, Monday through Friday, to show you houses. So just talk about scheduling on the front end so that there aren't any misunderstandings and conflicts that could cause hurt feelings and really a breakdown in your relationship with the realtor that you select. Another thing to think about is trust and rapport. Sometimes we meet someone and we feel that instant connection and chemistry with them. Other times it might take you an interaction or two to kind of warm up to the person. I think in real estate, it's important that you feel some kind of connection and rapport with your real estate agent sooner rather than later, as early on in the process as possible. And the reason is because you're going to be spending a lot of time with that person, looking at houses, talking on the phone, emailing and texting back and forth, and you just want it to be a comfortable relationship. So if you're interviewing agents and you're just not feeling it in that first conversation or two, don't feel bad about eliminating that agent from the list of possibilities. The next thing that you'll want to discuss is commission and fees. There are some agents who charge a retainer fee to work with buyers. If you purchase a home, that retainer fee will be refunded to you. If you don't purchase a home, the retainer fee will go to cover the real estate agent's expenses in working with you for the period of time that they did. As far as commission goes, you'll need to discuss that too. How much the agent is charging you to work with you, and whether you'll be responsible for making up any difference between the commission being offered by the seller and the commission that the agent expects to receive. So let me just clarify for a little bit. It's customary in Georgia for the seller to pay the real estate commission. And here's how it works. When a listing agent lists a property, that listing agent and the seller agree on a commission. Let's say that they agree that the commission the seller is going to pay is 6%. The time that they enter into that agreement, the listing agent must disclose to the seller how much of that 6% commission he or she is going to share with the selling agent. The selling agent is the agent representing the buyer. So let's say that the listing agent discloses that they're going to give 2.5% of that 6% commission to the selling agent. So let's say you've hired me, and in the buyer brokerage agreement that you sign, I have indicated that I expect you to pay me and Coldwell Banker 3%. I have also indicated that if the commission being offered by the seller is less than 3%, that you'd be responsible for making up the difference. So in this example, because the commission being offered to the selling agent is only 2.5%, and I expect to get 3%, you would be required to make up that 0.5% difference. So all of that will be spelled out in the buyer brokerage agreement that you sign, but it's important that you understand that before signing it. You know, if you have any questions about anything in the buyer brokerage agreement or the customer acknowledgement, be sure to ask those questions before you sign the document. So on to the next slide. Home search. You're going to discuss your wants and needs with your realtor. So I think that it's really important that you have a pretty clear idea of what those wants and needs are before you start interviewing realtors. So my suggestion is that you get a sheet of paper and divide it in two, divide it in half. On the left side, write down everything that you must have in the home, everything that would be a deal breaker if the home doesn't have that particular feature. On the right-hand side of the sheet of paper, write down the things that you'd really like to have, but that if you had to, you could live without them. By doing this, you're clarifying in your own mind the type of home that you want. And then you can share that information with your realtor. Your realtor will then use the criteria that you've given him or her to set you up to receive listings via email. And keep in mind that there's some things that we can't search for, like we can't search for hardwood floors, or I can't even think of a good example. Oh, open floor plan. Those are the types of things that you'll have to glean from either looking at the photos in the listing or by visiting the property. But we'll go ahead and set you up. Normally, we're not looking at every listing that you receive, because at the same time that you get them, we get them. Once you've gone through the list, identify the properties that you want to see and share that information with your realtor. Your realtor will tell you whether they want to get listing numbers or addresses from you. But once they have that information, there's a process that they need to go through. So it might not always be feasible for you to call your realtor up on Saturday morning and say, hey, are you available to show me these 7 houses this afternoon at 1 o'clock? So I advise you to give your realtor the listing numbers or the addresses of the houses that you want to see at least a day to a day and a half before the time that you have scheduled with your agent to go out and look at properties. Here's what we do. Here's what most agents do. They're going to make contact with the listing agent to verify that the property is still available and to get showing instructions. Sometimes the showing instructions are in the listing, but sometimes it requires a phone call. The other thing is that if a property says that showings are by appointment only, your agent needs time to schedule the showing. So once all of that has been done, your agent needs to set up an itinerary. We want to work as efficiently as possible. So we would rather go from point A to point B to point C in a straight line, if at all possible, rather than going from, let's say, South DeKalb, Fulton, and then down to downtown Decatur, and then up to Gwinnett. We would rather go in as straight a line as possible to get to the properties that you want to see. Houses in one outing, I'd say eliminate at least 4 of them. Just eliminate them. And then if you're thinking that you want to make an offer on one of the remaining 4, make the offer. If you're thinking that you want to go out once more and look at a few more houses, do that. And when you're looking at those, rank them among the top 4 from your first outing. And discuss your selections with your realtor. And when you feel ready to make an offer, your realtor will help you with that. But keep in mind, if you're a customer, your realtor can't advise you on how much to offer or write that offer for you. So when you're ready to make an offer, it's important that you understand what that process entails. So in this short video, Jessica is going to explain to you about making an offer.
Hi, I'm Jessica Edwards with Coldwell Banker Real Estate. What does it mean to make an offer on a house? Well, when you make an offer on a property, you typically sit down with your agent. You've selected the property that you think that you want to purchase. You go through the paperwork and whatever you want to ask for as far as price and terms and negotiations, that first offer starts that process with the seller. It's important to remember that making an offer on a property doesn't mean that the house is actually yours. There's usually a lot of back and forth and negotiations that go on between the buyer and the seller until they can come to terms of an agreement, finalize the offer, and then move forward toward the closing process.
So, as Jessica said, there's a lot that goes into making an offer. You need to decide how much you want to offer, how much earnest money you're going to pay, when you're going to close, the closing attorney, how long the due diligence period is going to be, the contingencies, the date of possession, the time limit of the offer, and any special stipulations. There's a lot that goes into it, and your agent is going to explain all of this to you. One of the things that I want to touch on right quick is, what is earnest money? A lot of first-time home buyers don't understand it. The definition of earnest money is that it's a sum of money paid by a buyer at the time of entering a contract to indicate the intention and the ability of the buyer to carry out the action. The earnest money is applied toward the purchase price, and it may be forfeited if the buyer defaults. So when you're ready to make an offer, your agent will advise you on how much earnest money you should put down. In Georgia, it's pretty customary if the sales price is under $100,000 to put down $500 earnest money. If it's between $100,000 and about $250,000, maybe $1,000. If it is above $250,000, the earnest money could be $3,500 or more. And there are some sellers who some buyers who, to demonstrate to the seller that they are really serious, will put down $5,000, $10,000, $20,000 worth of earnest money. I had a gentleman last year who made an offer on, I think it was about a $350,000 house, and he put down $20,000 earnest money. So once you've made your offer, the seller has 3 options. He can accept your offer outright, he can reject your offer, or he can make a counteroffer. And if he chooses to make a counteroffer, that counteroffer can address any of the terms set forth in your offer. There will be a time limit for you to respond to the counteroffer. You're not going to have 3 or 4 days to think it over. You may have as little as 24 hours. I have actually seen contracts or counteroffers come through where there might be 10 or 12 hours for the buyer or the other party to respond. If the seller makes a counteroffer, you have the same 3 options that he had when considering your offer. You can accept his counteroffer as written. You can reject it outright, and if you do, that means that it's a done deal. You're no longer interested in that property. Or you can make a counteroffer. You and the seller can counter and multiple times. You can go back and forth multiple times until you reach an agreement or until either of you decides that it's hopeless and you're just wasting your time and that it would be best to move on. But once you have an offer, you are said to have a binding agreement. And the date that you reach the binding agreement is a very important date, and it's known as the binding agreement date. It is the date that the party who made the offer or last counteroffer receives notice from the other party that the offer or last counteroffer has been accepted. And in most real estate contracts, all deadlines are measured from the binding agreement date. That's why it's a very, very critical date. There is one exception that I can think of offhand, and that's the short sale. A good buyer's agent will include a provision in the contract that says that, and we're talking about a short sale in this instance, but will include a provision that says that all dates that are ordinarily measured from the binding agreement date will instead be measured from the date the buyer receives written notice that all lien holders required to do so have approved the short sale. So just keep that in mind if you're making an offer on a short sale. So once you start that offer process, you're going to get disclosures from the seller. In many cases, the listing agent will upload the disclosures into the multiple listing service so that the buyer's agents can share that information with the buyers as they're preparing to make an offer or considering making an offer, as the case may be. If the disclosures were not uploaded to the multiple listing service, once you have a binding agreement, you will get whatever disclosures are available. And the most common disclosures are the seller's property disclosure, the lead-based paint disclosure, and the community association exhibit. There are other disclosures, but I'm just going to talk about these 3 because they're the most common ones. The seller's property disclosure is the way that the seller notifies you as the buyer or informs you of any known defects or issues with the property. If you are purchasing a foreclosure, you will not get a seller's property disclosure. If you are purchasing a short sale that is owner-occupied, you should get a seller's property disclosure, but you may not. There are some agents who, for some reason, don't have their sellers complete a seller's property disclosure when the property is being short sold. I don't get it. I always have my sellers complete a seller's property disclosure when they're short selling the property. If you are purchasing an investor-owned property, you probably won't get a seller's property disclosure. You may, but it really depends on the particulars of the seller's situation. If you are purchasing an estate-owned property, you may get a seller's property disclosure, but again, it depends on the circumstances. If the executor happens to also be an owner-occupant of the home, then you would get a seller's property disclosure. If the executor has never lived in the house, you wouldn't get one. The lead-based paint disclosure is required under federal law to be provided by the seller to the buyer on any home built before 1978. However, there are some listing agents who, as a best practice, have all of their sellers complete a lead-based paint disclosure, even on homes built after 1978. And the purpose of the lead-based paint disclosure is, number 1, to disclose whether the seller has any knowledge of there being lead-based paint on the property, and to tell the buyer that they have a 10-day period during which to have the property inspected for lead-based paint. And that's it in a nutshell. The community association exhibit will only be provided on properties that are in communities that have a homeowners association or a condominium association. And the purpose of the community association disclosure is to tell the buyer how much the homeowners association dues are, how often they're required to be paid, monthly, quarterly, semi-annually, or annually, whether there are any special assessments, whether there is a master association, and if there is a master association, what the master association fee is, what the homeowners association dues cover, whether there is an initiation fee that must be paid when the buyer closes on the property, etc. So the next question is, what happens once we have a binding agreement? After the parties reach an agreement? Well, the first thing that happens is that the due diligence period begins to run. And the due diligence period is the period during which the buyer can have the property inspected. So you'd be able to have the home inspection done, a termite inspection, a lead-based paint inspection, a radon inspection. You could have the HVAC system inspected. You could have the chimney inspected. You could have the septic tank inspected. Any inspection during the due diligence period. And before I go on, I just want to say one quick thing about the difference between a home inspection and an appraisal. The purpose of a home inspection is to ascertain the condition of the structure, to determine the structural integrity of the property. An appraisal, on the other hand, is meant to ascertain the value of the home. They're completely different. A lot of first-time home buyers think, oh, well, you know, the bank is going to have the property appraised, so why do I need to get a home inspection? He may identify certain issues with the property that the seller needs to address. It is not nearly as in-depth as the home inspection. So what you need to understand about the due diligence period is that if you terminate the contract during the due diligence period, and you're entitled to do that for any reason, you'll get 100% of your earnest money back. I just want to repeat that. You are entitled to terminate the contract for any reason during the due diligence period and receive a 100% refund of your earnest money. If the due diligence period has expired and you have not had the property inspected and you wish to do so, you can still get it inspected. However, you would be required to purchase the property as is, regardless of what issues your inspections might uncover. If you have the home inspection or any inspections done during the due diligence period and you wish to ask the seller to address concerns with the property, to make repairs to the property, and you and the seller have not come to an agreement on which repairs he's going to make and the due diligence period expires, you're required to purchase the property as is. So it's very important that you have your inspections done as early on in the due diligence period as possible to give you an opportunity to present to the seller a list of repairs that you'd like him to make and to give him an opportunity to respond. If it looks like your due diligence is going to expire and you and the seller have not come to, make a request of the seller to extend the due diligence period. He doesn't have to agree to that. And if he doesn't, you can terminate the contract and get your earnest money back as long as that due diligence period hasn't expired. But you can see that, 10 days seems like a long time, but that time can pass by so quickly. So you don't want to wait until day 9 to have the inspections done. Do them on days 2, 3, and 4 so that you have enough time to review the reports and make that request and get with the seller to negotiate which concerns he's going to address and so on and so forth. Let's talk about the contingency periods. The two most common contingency periods are the financing contingency and the appraisal contingency. Appraisal contingency is usually 2 or 3 days shorter than the financing contingency. And I want to talk about the appraisal contingency first. If the appraisal contingency expires and you haven't had the property inspected yet, or your lender hasn't had the property inspected yet, or appraised yet, I'm sorry, you will be required to purchase the property for the agreed upon sales price. So let's just say, for instance, that you have the house under contract for $250,000 and you have an 18-day appraisal contingency period and it expires. The appraisal is conducted on day 19 and it comes in at $235,000. You'd still be required to purchase the property for $250,000, but your lender isn't going to lend more money than the property is worth. That means that you would have to bring $15,000 to closing to make up that difference. If you have the property under contract and you have the property inspected on day 10 and the appraisal comes in $15,000 under the agreed upon sales price, for instance, you can ask the seller to reduce the sales price. And if the seller is unwilling to reduce the sales price, you can rent and get 100% of your earnest money back. Let's talk about the financing contingency period. That's the period during which the loan must be underwritten and either approved or not. If the loan is not approved and you do not have a letter that states that by expiration of the appraisal contingency period, you are required to purchase the home and pay for it the best way you can. Well, most of us don't have $250,000 laying around to pay for a house. And if we happen to have $250,000, the last thing that we want to do with it is use it all up to pay for a house. So it's very important that you're in constant contact with your loan officer and that you know that the processing and underwriting is going on. If it looks like you're not going to have that final decision before your financing contingency period expires, you need to request an extension of the financing contingency period. So just keep these dates in mind, stay on top of them. Your real estate agent will help you stay on top of them. And if any extensions are necessary, try to get them taken care of before the day that any of these periods expire. So once your loan is approved, your loan officer is going to submit a title order to the closing attorney. Excuse me. And that is the closing attorney's trigger to have a title search done. And the purpose of the title search is to ascertain the status of the title. Is the title such that the seller can convey good and marketable title to the buyer? If there are any liens, such as a mortgage or any judgments against the seller, those must be paid off in order for the seller to be able to convey good, clear, and marketable title to the buyer. And so the closing attorney's role is to gather any necessary payoffs and to basically make sure that everything that needs to be addressed gets addressed so that at closing, the buyer is receiving good, clear, and marketable title. Your loan officer is going to go over the final loan terms with you and provide you with an updated good faith estimate. Effective August 1st, there's a new law that's going into effect. This is a law promulgated by the Consumer Finance Commission, the CFCP, I think it's called. Anyway, and under that law, the good faith estimate, I don't remember the name of the document that will replace the good faith estimate, and I believe the name of the document that will replace the HUD-1 is the closing disclosure. If you purchase the First Time Homebuyers Bootcamp Companion Guide that I mentioned earlier, it does go into some detail about this new law and what the names of the new documents are. But at any rate, whether it's the good faith estimate before August 1st or the new document after August 1st, your loan officer is going to give it to you. And there is some talk that the effective date of this new law is going to be extended to the end of the year, but that has not happened yet. So as of this presentation, the effective date of the new law is August 1st. So another question that first-time home buyers have is, what is title insurance? There are two types of title insurance: lender's title insurance, which is mandatory, and owner's title insurance, which is optional. Lender's title insurance protects the lender in the event that there is some issue with title. Owner's title insurance protects the buyer. And when I was doing closings, I always put the premium for owner's title insurance on the settlement statement and made the buyer ask me to take it off once I had explained to them what owner's title insurance is. And I encourage you every year, whether you're a first-time home buyer or this is your 6th or 7th house that you're buying, to get owner's title insurance. It is the cheapest insurance that you'll ever get. You pay a one-time premium. The coverage is good for as long as you own the property, regardless of how many times you refinance. And it is protecting your ownership in probably, arguably, the most expensive asset that you'll ever purchase. So I can't emphasize to you how important that it is to get owner's title insurance if there happens to be a judgment that gets filed after the title search was run and the title update that the closing attorney has done right before closing doesn't show it. It's going to protect you. If there is some boundary line dispute, your title insurance will protect you. If there was an error in the legal description in your warranty deed, the owner's title insurance will protect you. So it's just a really good idea to have it. And I'm going to move on. I don't want to keep harping on it. I think you get my message. So at the closing, you're going to get your final HUD, but you do have the right to review a preliminary HUD 24 hours prior to closing. The closing attorney is only required to provide you with a HUD containing the information that is available to him at that time. So if the closing attorney hasn't received the closing instructions from your lender, the HUD that you receive might not have a whole lot of useful information on it. You'll need to wire your funds to the closing attorney. If your down payment is more than $5,000, you must wire the money. Some closing attorneys will accept a cashier's check for amounts between $1,000 and $5,000. Others will not. They only want a wire. And there are some closing attorneys who will accept a personal check for amounts under $1,000. So it's important that you find out what the closing attorney's policy is with regard to personal checks and cashier's checks. Georgia law mandates that any funds in excess of $5,000 be wired. Before you wire any money, whether you've gotten the wiring instructions directly from the closing attorney or from your real estate agent, pick up the phone and call the closing attorney to confirm that the wiring instructions you have are correct. There are some fraudsters out there, accounts of real estate agents. I haven't heard it happening with closing attorneys, only with real estate agents, but just be on the safe side and always call to confirm the wiring instructions. And if a real estate agent is using a free email account like Gmail or Yahoo, it is highly susceptible to this kind of fraud. These fraudsters are hacking into these agents' email accounts, and when they see an email make reference to wiring instructions being attached, they grab that attachment, they doctor it with their personal banking information, and then they send an email to the client that appears to be from the real estate agent. And the email says, hey, I just found out from the closing attorney that the wiring instructions that I sent to you earlier were old. Please use the updated wiring instructions that are attached. Well, the buyer looks at the email. It appears to be from their agent. They don't suspect that anything, crazy is going on, and they wire the money, and they're sending it to a crook. Well, that, of course, creates a whole lot of headaches and a whole lot of problems for people. So just to be on the safe side, when you receive those wiring instructions, whether directly from the closing attorney or from your real estate agent, pick up the phone and verify with the closing attorney's office that you have the correct wiring instructions. You need to bring your photo ID to closing, and you should be prepared to provide a second form of ID. Some lenders are requiring that now. And also bring your homeowner's insurance declarations page to the closing, or you can have your insurance agent fax or email it to the closing attorney. So once you're at the closing table, the closing attorney is going to explain the HUD-1 settlement statement or the closing disclosure to you, as well as explaining the other documents, and you and the seller will sign them. You're going to receive keys to the property, the garage door openers, and any information that the seller might have about the property. For instance, if there is a 2-year warranty on the roof and the roof is only 9 years old, the seller might bring that warranty to closing or tell you that it's there on the kitchen counter for you. He might bring, if the property is in a community that has a homeowners association, he might bring to closing the declarations of covenants and restrictions for you, or tell you that, you know, he left them for you on the kitchen counter or in a drawer. Those are just examples. The closing attorney will disperse the funds collected at closing. That might be the property taxes, if taxes are due, the homeowner's insurance, if you haven't already paid your first year's premium up front, any homeowners association dues that might be due. If you purchased a home warranty, that will be paid for. The seller's mortgages and any other liens against the seller will be paid off. And the warranty deed and security deed will be sent for recording, and the lender's fees will be remitted to the lender. The closing attorney is going to issue the lender's and owner's title insurance policies. That is usually done at closing. Sometimes those policies won't be issued until after the warranty deed and security deed are recorded. But once your warranty deed comes back from recording, the closing attorney will mail that to you. You're going to get copies of all the documents that you signed. They may not bear your signature. If you want copies that actually have your signature on them, ask the closing attorney, and he or she will usually be happy to have one of the secretaries make copies for you. Keep in mind, if you're the type of person who wants to read every document word for word, you're not going to have enough time to do that at the closing table. You need to let your real estate agent or the closing attorney know that you want to look at everything before you sign it, and they will make every effort to accommodate you so that you can come into the office the day before or a couple hours before closing and go over the documents. So after the closing, you need to keep your closing documents, including your HUD-1 or the closing disclosure, in a safe place. You might need to refer back to those documents for tax purposes, you know, or you might want to check and make sure of when your first mortgage payment is due. So don't just take those documents and throw them in your trunk and forget about them. Keep them where you can get to them. You'll also need to keep your warranty deed and your title insurance policy together in a safe place. That can be a strong box or a safe deposit box. I prefer the safe deposit box because it's right there at home. If I need to pull my deed out to make a copy of it for some reason, it's right there. I don't have to make a trip down to the bank to get into my safe deposit box. If you're an owner-occupant, you'll need to file for your homestead exemption, and you can do that beginning on January 1st of the year following your purchase of the property. And depending on what county, 31st to file for your homestead exemption. And by filing for the homestead exemption, you are certifying to the county tax assessor's office that you are an owner-occupant, and that entitles you to a small discount on your property taxes. So that is it for the First-Time Homebuyers Bootcamp. I hope you found this presentation useful. And if for some reason you have any questions about the First-Time Homebuyers Bootcamp, please feel free to give me a call. And it looks like I'm freezing up again right at the end. But please feel free to give me a call. My number is 678-446-5925. Be sure to purchase your copy of the First-Time Homebuyers Bootcamp Companion Guide. After you've gone through the guide, again, if you have questions, give me a call. I So look forward to hearing from you, and whether you are purchasing a home for the first time, or you know someone who's looking to purchase, or you know someone who wants to sell, I would be more than happy to talk to you and answer your questions. And if you want to hire me, that would be great too. So thank you so much, and I look forward to hearing from you. Have a great day.